Hi everyone, my name is Sahil Saluja and I welcome you all to episode 2 of ET Money Answers. In this video, we shall be looking at some of the most frequently asked questions on mutual funds which have been received by us over email, YouTube, Twitter and other social media channels. And to answer these questions, we have our ET Money expert Mr. Shankar Nath, whom you would have seen in many of our YouTube videos. And since we'll be covering a lot of questions, this video might be a bit long, so feel free to use YouTube's chapter function to skip to the part that interests you the most. Let's begin with question number 1. Now Shankar, as a company, we've been saying that direct plans build a lot more investor wealth as compared to regular plans. Can you share some numbers around it?
Yeah, sure, Sahil. As a matter of fact, we did a study recently where we examined the last 8 years of performance of over 250 equity and debt schemes. And what we were specifically looking for was the direct and the regular plan performance for these schemes. Now, specific to equities, our study found that the difference in the annual returns between a direct plan and a regular plan was about 1.2%, which can be quite a difference when you look at it over longer periods of time. For example, we did this study over an 8-year period, and the difference of 1.2% gave us almost a 10% difference between what the regular plans were offering in terms of total performance and the cumulative value of the portfolio in a regular plan. Of course, we could not look beyond 8 or 9 years because direct plans came into existence only in 2013. But if we were to extrapolate this 1.2% number over a longer period of time, let's say 20 years or 25 years, then the difference would be pretty substantiative. It will be like 30, maybe 35%, which should be a big incentive for anyone to move from a regular plan to a direct plan. So in effect, the portfolio remains the same, the fund manager remains the same, everything is the same, except for the expense ratio, which is a lot lower in direct plans, and that's why we kind of promote that variant over the regular plan, because it's anyway much better for the investor.
Okay, got it. So Shankar, a follow-up question to this is, if an investor is keen to move from a regular plan to a direct one, then how can he or she do that? And what are some of the things that one can consider while making the switch?
Okay, so these are two questions. Your first question is how to move from a regular plan to a direct plan. Now, the easiest way to do that is by using the switch to direct functionality that is generally offered by mutual fund platforms. Not all of them offer it, but most of them do offer that. In fact, ET Money offers it, and it's a wonderful feature because it not only takes care of the execution, but it also does it in a very convenient manner, because the app not only identifies which are those plans which are still under a regular plan that need to be switched, but it also executes the entire process at the tap of a button. Now, it's important to understand what is really happening at the back end, because when an investor switches from a regular plan to a direct plan, what he's effectively doing is he's selling units in the regular plan and buying units in a direct plan. Now, this has some implications, which is what your second question is all about. The first consideration here is the type of fund. So if the scheme you want to move from regular to direct is, let's say, an ELSS fund, or if it is some kind of a children's fund or a retirement fund where there's an element of a lock-in period, then you can't make that regular to direct switch so conveniently. You'll have to wait for that lock-in period to get over. The second consideration when you do this regular to direct switch is to understand your taxation, and by virtue of the fact that units are being bought and sold, there will be some capital gain tax, whether it's short term or long term, that will be there, and it's something that you have to take care of when you're filing your income tax returns. And the third and final point that one needs to look after is the exit load. Now, when it comes to exit load, there's no straight answer that if exit loads will be applicable on those funds or not. So, for example, if we stick to equity funds, most of the schemes that we have do not have any exit load beyond a 1-year period. In fact, some AMCs like Motilal Oswal have a much shorter exit load period of just 15 days. Also, funds like fund houses like Franklin Templeton, I think since 2019, they have been waiving off exit loads if an investor of theirs switches from regular plans to direct plans. So if I look at the overall picture, there's an encouraging shift that is happening from regular to direct. And as consumers, it's obviously very good for us because it's a way of actually getting more returns. And the more returns that consumers get, the consequence of that will be a much higher asset base for the mutual fund industry.
Okay, so mutual fund schemes may or may not have exit loads, but every scheme does have an expense ratio, and I believe investors do take this into account while taking decisions. In that context, one of our investors posed the following questions, and I'm reading it out to you. Is it better for me to invest in a fund that has delivered 13% returns at 1% expense ratio, or is it better to invest in a fund that has delivered 14% returns at a 2% expense ratio? What is your advice on this?
Okay, so firstly, yes, it is very common to see investors examining the performance column, and then they tend to look at the expense ratio when comparing funds. It's becoming standard practice now. Now, specific to the question you've asked, I think there is some misunderstanding here. You see, when a mutual fund company displays the returns of the scheme, it does that by using the scheme's NAV, which already incorporates the current expense ratio of the scheme. So this 13% return and 14% return that you stated, these are not a pre-expense ratio performance. So 13% and 14% already includes the expense ratio, which means that the expense ratio information you gave me, which was 1% and 2%, it's just supplementary information and it's not really a decision point. But having said this, expense ratio does become a decision point in some cases where the returns are expected to be more or less similar. And I think the best example of that would be index funds. So when we look at the Nifty 50 data, we see that the sweet spot on the expense ratio is between 0.15% and 0.22%. That's like the range where most of the funds are kind of there. In fact, I'll request the video editors to post a chart on the screen which can clarify this better. Now, what's important to note is that the Nifty 50 index scheme, which has the higher expense ratio, often tends to offer the lower returns. Now, I'm sure a follow-up question that might come in would be, what about the index funds which have a low expense ratio, and specifically that reference would be to the Navi Nifty 50 index fund, which I think offers like a 0.06% expense ratio. Now, this fund is a new fund, so we don't have much information on it. But from what we have seen from the last 6 months of performance data, what we see is that this scheme has been amongst the highest performers within the available set of Nifty 50 index funds, which kind of supports our point that the lower the expense ratio, the higher would be the returns from an index fund perspective, and vice versa.
Okay, thanks for clarifying this, Shankar. So there are taxes, there are exit loads, and there are expense ratios. Are there any other penalties or charges that need to be paid in a specific scenario? Let's say I don't pay my SIP installment for a month, or say I want to cancel my SIP?
Right. So it's a very good question, Sahil, and I can understand where this is coming from. So this concept of penalty or surrender charges is something that we see with traditional products like fixed deposit, or in the case of a life insurance endowment policy or a ULIP policy, etc. Now, these products require investors to pay a penalty or to pay surrender charges when they deviate from the original product plan that they had. Now, thankfully, there is no such thing when it comes to mutual funds. So if you want to cancel an SIP, there is absolutely no problem. You can go ahead and cancel it, and it's as simple as tapping a button on the ET Money app. As a matter of fact, there is also an SIP pause facility on the app, which allows investors to halt their next SIP installment by tapping that button. Now, beyond voluntarily cancelling or pausing an SIP, it's also possible for an investor to miss an SIP, which generally happens if you don't have, let's say, sufficient balance in your bank account. In these cases as well, the mutual fund company will not levy any fees or any penalties on the investor for the non-payment of SIP. So in the back end, what is really happening here is that no units are being allocated for that month to the investor because no money has come in. And in case you fail to make the payment for 3 consecutive months, then the AMC automatically cancels your SIP. So that's the standard operating procedure that the AMC follows. Now, having said this, while the mutual fund company or a platform like ET Money does not levy any penalty, it is possible that your bank might penalize you for dishonoring the auto debit payments. So there's still a possibility that between you and your bank, there might be some loss to you as a penalty. But as far as the mutual fund company or say a platform like ET Money is concerned, we do not charge anything there. So that's something that someone should be clearly aware of.
Okay, understood. Dividends is another area where we've got some more questions. Let's start with this one. Dear ET Money team, there used to be something called a dividend plan which has now been replaced by an IDCW plan. Can you shed some more light on this?
Sure. So IDCW stands for Income Distribution cum Capital Withdrawal. Now, an IDCW plan is not some new innovation. In fact, it's exactly what was previously called a dividend plan. So, in essence, all that has happened is that there is a name change which has happened here. To understand why this has happened, we have to first understand how a dividend plan actually works. So firstly, the misunderstanding that investors who put in their money in a dividend plan have is that they think that the fund is merely collecting the dividend that the scheme gets from the shares that it holds and that it is distributing this dividend to the investors. Now, the problem with that logic is a bit mathematical nature. You see, the average Nifty 500 dividend yield is presently about 1.5%, and it's been around that number for a few years now. But let's assume that a mutual fund company announces a dividend of 4%, which is a pretty big number as compared to 1.5%. So any investor would, it'll sound like a very sweet deal for him or her. But what's really happening is that the equity fund is probably generating the typical 1.5% dividend, but that remaining 2.5% is actually coming out from the investor's capital. So I hope you can understand the problem. So while the investor is expecting 100 rupees plus 4 rupees, that is 4% being the dividend, what is actually happening is that the investor is being paid 97.5 rupees plus 4 rupees, which effectively means that this dividend of 4 rupees that the mutual fund has been paying, as a consequence of that, the NAV will actually go down from 100 rupees to 97.5 rupees. So it's like the dividend plan actually paying back some of your own money as dividend, and this is what a lot of investors were failing to understand, and probably that's the reason why SEBI kind of replaced this word dividend with IDCW, or the Income Distribution cum Withdrawal Plan.
All right, that was good to know, Shankar. So yes, mutual funds do receive dividends from the stocks they invest into, and in case of a dividend plan, this money somehow reaches the investors. And this is a much asked question by investors, what happens to the dividend received from stocks in case of a growth plan? Can you shed some light on that, please?
Okay, so I can understand where you're coming from, and it's not just you. I think a lot of investors have this notion that AMCs keep all the dividend that's received from the stocks that they own, they kind of keep it to themselves, which is really not the case. See, the dividend that the AMCs receive from their equity holdings comes in the form of cash to the fund. And this amount, this cash, actually gets immediately reflected as an increase in the NAV of the fund. Now, over time, or pretty quickly actually, this cash is then deployed by the fund management team, and they have multiple options. They can either keep it as cash, they can buy more shares in the same company, or they can buy shares in a different company, or else they can even keep this money in a liquid fund to help with redemption pressures. Now, the flexibility that I mentioned here in how a fund can use the dividend is generally available in actively managed funds. But when it comes to index funds and ETFs, for these instruments, deploying this dividend as quickly as possible is very important, because they need to mirror the index at all given times. And that's because the more they delay the deployment of this cash, the greater will be the tracking error in these funds, which is something that these index funds really want to avoid. So net in the case of active and passive equity funds, the dividend that is received by the scheme from the equity holdings that they have, that is completely consumed and deployed as per the scheme's objectives.
Okay, this is good. Shankar, a few viewers are saying that you use some technical words which are a bit difficult to understand.
Okay, what are those words?
Here we go, words like benchmark, CAGR, alpha and TRI. I think you use this word TRI quite a bit. Can you quickly help us with what these 4 words mean?
Okay, so very quickly, the term benchmark is quite simply a reference point against which a mutual fund's performance, its risk metrics and its allocation is compared. So for example, when it comes to large cap funds, most of those schemes use the Nifty 50 TRI as the benchmark, while a few schemes also use the Nifty 100 TRI. I apologize for using this abbreviation TRI once again, but I'll address that in just a minute. So large caps use the Nifty 50 or Nifty 100 as their benchmark. Mid caps will use the Nifty Mid Cap 100. Gold uses the domestic price of gold. Similarly, long duration debt funds use the Nifty 10-year GSEC index as their benchmark, and so on. So in essence, the benchmark is a very important reference point, because the primary goal of every actively managed mutual fund is to first beat the benchmark, which has become very difficult in recent times, not only in India but all around the world. So that's what we mean by the benchmark. The next term is CAGR, which stands for compounded annual growth rate. Now, mutual fund returns are the returns that you get on mutual funds are always non-linear. That is, you can make 25% in 1 year, but it's possible that the next year's returns might be a much lower 5%, and in some years it can go negative also. So what the CAGR does is that it provides a smooth rate of return between 2 points of time. So for example, say we need to find the CAGR for an investment between 1st of January 2017 and 31st of December 2021. So say the NAV at the beginning of 2017 was 100 rupees, and say the NAV on the 31st of December 2021 was 200 rupees. So it's a 5-year period that we're talking about. So when we apply the formula, the CAGR formula, to these values, we get the 5-year CAGR, which in this case comes to 14.87%. Now please note that this does not mean that the mutual fund grew by 14.87% every year. In fact, it's possible that the NAV over these 5 years must have gone up, must have gone down, must have gone sideways. But the CAGR attempts to do only one thing, which is to give you a single number that represents the asset's average growth rate over the entire 5-year period. So that's CAGR. Okay, so the next term is alpha, and this term is very basic. All it kind of explains is the level of overperformance or underperformance of a fund as compared to the benchmark. So for example, the Tata Large Cap Fund delivered 33.9% returns last year. So the Nifty 50 TRI delivered 24.4%, which means in this case, we can say that the Tata Large Cap Fund has delivered an alpha of 9.5%, which is simply 33.9% minus 24.4%. And finally, we have the term TRI, which stands for Total Return Index. You see, the daily Nifty or Sensex values are computed on the basis of the stock price of the individual companies that make up the index. But as we understood earlier, a lot of these companies also pay dividends, which also gets added up to the returns offered by the mutual fund companies, which is actually a good thing from an investor's perspective. Now, to do a proper apples to apples comparison, we prefer looking at the TRI, or the total return index of the benchmark, which captures not only the price movement, but it also captures the dividend payments of the stocks that it holds. So for instance, at the time of recording this video, the Nifty 50 is at around 17,200 points. But if one checks out the NSE India website, we'll find that the Nifty 50 TRI index is a lot higher at around 24,700 points. This additional 7,500 points represents the dividend that has been adding and accumulating and compounding over the last many years. So hopefully you can now understand what the word TRI really represents, and we use it in all of our videos for the simple reason that this is the right way of doing a fund evaluation, at least from a performance standpoint, because dividend is actually a part of investor returns and it should obviously be factored in all our calculations.
Great. So Shankar, let's move on to some questions that people have on how to use mutual funds smartly to achieve their investing goals. Now, one of the most common questions in this regard is what type or what types of mutual funds are an ideal investment vehicle for a beginner or someone who's investing via mutual funds for the very first time?
Yes, this is a common question, Sahil, and I can't stress enough the importance of getting your first fund absolutely right. Because if you get it right, it sets you on the path of wealth creation. But if the selection goes wrong for any reason, then it takes some time before a person kind of finds back the confidence to invest. So I can understand the importance of this question. Now, the first fund that for a beginner or for anyone who is new into investing needs to qualify some criteria. Firstly, it should be simple to understand, which means I won't recommend a momentum fund or a quant fund. Secondly, the fund should not take any undue risks, which is where a thematic fund or even a small cap fund does not make the cut. And thirdly, the fund should have some inbuilt cushioning effect that can take care of the sharp downturns. So three things: simplicity, relatively lower risk, and some kind of protection against sharp market falls. So in that context, we suggest one should look at these two different categories of funds as your first fund. The first one is the ELSS funds, and we suggest that because A, they are very simple to understand. They invest in large caps mainly with some exposure to mid and small cap companies. They have a 3-year lock-in, which in my opinion is a hugely beneficial thing because it kind of forces the investor to think long term, which improves his or her chance of making good returns. And of course, as a bonus, ELSS funds also help you save taxes as per Section 80C of the Income Tax Act. A second option that beginners can explore as their first fund is to look at aggressive hybrid funds, which were earlier called as balanced funds. Now, these funds typically have a mix of equity and debt, with the equity portion being around 65 to 70%. Now, the charm of these funds is that they utilize different asset classes, namely equity and debt, as a part of their composition. Secondly, the fund manager also actively adjusts this equity and debt ratio according to the market situation, which not only helps in taking advantage of market opportunities, but it also provides a very nice cushion against sharp market falls. Also, from a performance perspective, what we have seen is that these aggressive hybrid funds, they tend to perform reasonably well, with the average fund delivering a CAGR of around 14% over the last 5 years. So in our opinion, either go for an ELSS fund or invest in an aggressive hybrid fund if you are a beginner to investing.
Okay, next one, which is the best investing platform for mutual funds? Well, I think I can answer this one, and the right answer to this has to be ET Money. And one can understand why. We are India's top mutual fund investing platform with over $1 billion in asset under management. We offer only direct mutual funds which improve investors' returns. Our app functionalities and designs are excellent, which is why we have a super high rating of 4.5 on Play Store. And we complement our tech with education, the proof of which is this YouTube channel. Plus guys, we have now introduced Genius, which is a pack of multi-asset investment strategies that does everything you want an intelligence investing system to do for you. It invests across different asset classes like equities, international equities, gold, debt. It runs on a quant-based proprietary model which is personalized per your risk profile. It decides the allocation based on various factors like interest rates, valuations, inflation, market trends. It is available for mutual funds or stocks, whichever you prefer. And my favorite part, Genius give returns which can challenge any top performing benchmark, and it does it by taking a lot less risk. So go to the ET Money app and check out Genius to understand why we think it will be a must have for all kind of investors. Alright, so moving on, the next question is, how can one select some good mutual funds for the next 10 years?
Well, the definition of good is very important here. For instance, if one says that the performance of the Indian stock market has been good, then the easiest way of getting a good performance out of your equities is to buy an index fund, and hopefully your returns over the next 10 years would also be good. So that's one way of going about it. Now, let's say your definition of good means doing a bit better than the Nifty or the Sensex. In that case, what really works is not choosing a particular fund, but rather a combination of funds. In fact, this can be a combination of even index funds like what we have in Genius, and then to apply the principles of asset allocation and rebalancing on top of it. This, more often than not, leads to a better risk-adjusted return for the investor.
Shankar, this next question, I guarantee you, it's not there to embarrass you and maybe you can tell us the story behind it. But a question that investors generally ask is, how many mutual funds should be there in a portfolio?
Okay, firstly, Sahil, thank you for that embarrassing trip down memory lane. And for people who are wondering what Sahil is teasing me with, it's some of those mistakes which I had made on this front many years ago. So you see, when I was younger, I think Sahil might not even have started working then. I used to invest in funds left, right and center, and I had like 70-80 schemes in my portfolio. It wasn't a botheration at first, but as the portfolio size increased, a high number of funds became very unmanageable for me. Of course, I've been trying to prune that number down, but with things like capital gains, exit load, etc., to think about right-sizing the portfolio after it has already been messed up is one uphill battle for me. But on the positive side, I did find that having so many schemes and categories gave me no demonstrable advantage in terms of performance. I also did not find any kind of diversification benefits, and most definitely managing such a high number of funds was a massive headache. So in our opinion, the stacking of funds has to revolve around what you think your ideal asset allocation is. And honestly, you don't need more than 4 to 5 equity funds, maybe a gold fund or 1 or 2 debt funds to actually have a clean and a very well balanced portfolio. In fact, if you take debt funds, now again, debt funds are of many types. But since we invest in debt funds for capital preservations, your choices have to be very simple. So maybe you can invest in a liquid fund or a money market fund for emergency situations. And you can explore an ultra short term or a short term fund which can do a bit better than your fixed deposits. Again, when it comes to a class like equities, what an investor should be aiming for is to balancing the ship with the right amount of large caps, mid caps, small caps, international exposure, and maybe some tax efficiency. So when you put this into a framework, then you're looking again at a maximum of 5 funds for all practical purposes. You can go with a large cap fund, a mid cap fund, a small cap fund, an international fund, and an ELSS fund. Now, while Genius makes asset allocation a lot more dynamic and scientific, if someone wants to do it themselves, in the old traditional way, then a kind of a combination, multiple kinds of combinations can be looked at. So for example, if your ideal asset allocation is to have, say, a 35% in large caps, a 20% in ELSS, and let's say 15% in each of those other 3 categories, which is mid, small, and international equities, then you can simply align yourself to the related funds as per this targeted ratio. It's not very difficult actually. And there are a number of categories that you can explore even outside of, let's say, a large cap or a mid cap. You can look at multi-cap funds, you can look at flexi cap funds, even the large and mid cap fund. But the idea should always be to kind of synchronize the funds that you have with that ideal targeted asset allocation that you want. So similar combinations can be done even with index funds, and this is becoming much bigger now, with passive investing options available across all asset classes and even the subclasses except for the ELSS funds. So there's a lot of flexibility there, but overall 5, 6 or 7 funds should be like ideal for any investor to get close to what he wants, and in a way that he can track his portfolio, he can manage his portfolio, and that the portfolio will be scientific in nature.
Speaking of keeping it manageable and scientific, many investors have been commenting that as the AUM of a mutual fund scheme increases in size, the fund managers find it a lot more difficult to manage their funds and the performance suffers. How true is this?
So on the face of it, size should be an advantage. After all, it helps in lowering the expense ratio of the fund. And secondly, when a fund has a sizable AUM, it does not feel any pressures when it comes to redemption. So it can always, it can always sell some of its stocks, but can still continue to keep the quality stocks within the portfolio. Now, as expected, money chases performance. So when a fund does well, more assets get attracted, and when the fund's performance slips, then obviously money moves away from the fund. From what we have seen, there is no general rule that seems to connect a fund's AUM with the performance. In fact, we've seen many funds which have managed performance quite well in spite of having large AUMs, and we've also seen many funds with much smaller AUMs but have remained stuck in the third or the fourth quartile in terms of performance. So I think this entire point of AUM versus performance is not really supported with data, but it seems more perception based. And the typical story is that smaller funds are more nimble and therefore they can move in and out of stocks, while a 20 crore fund might take a lot more time to offload even 1% of its holdings. And yes, while this might be a small botheration, we have to also remember that even small AUM funds have a lot of disadvantages, like they can't wholesomely participate in IPOs, they can't diversify as much because of lack of money. The scope of the research, and I think this is the bigger point, the scope of the research is going to be limited to just a few stocks, because they don't have money to pay for, researchers and analysts, etc. So there are pros and cons either ways, but to answer that question, no, we have not found any reasonable data to say that high AUM funds are handicapped because of size and they deliver lower performance. There is just no data available for that.
Okay, but what about this entire debate about investing in SIPs versus tactical lump sum investing? Like one of the questions we received is, and I'm quoting, "I would like to invest in equity mutual funds whenever I hear the news of a big market fall. Is it a good strategy?" I think it is an interesting question for you to answer, especially now when the stock markets have come down by 8-9% from its peak. What do you think about this lump sum strategy that is being proposed?
Okay, so I'm assuming this person is interested in using the buy on dips lump sum strategy over the long term, and is not a 1, 2 or a 3-year play that he's proposing. Because if it's a long-term play, then we honestly haven't seen any massive difference in performance by using the SIP way of investing or the lump sum way of investing in the market. But this thought is still interesting, and the way I look at it is that if a person is only looking to invest during market dips, then effectively what he or she is trying to do is to maximize one's percentage returns rather than maximizing one's absolute returns. Let me explain this with an example. Now, say our friend here is looking for a market fall, and let's define a market fall as a 5% dip in the Nifty over a single month. Now, when we look at this data over a considerably long period of time, so let's say the last 20 years, so from year 2002 until the year 2021, we find that there were only 27 months that fit this 5% criteria. This effectively means that our investor friend could have invested only 27 times under a lump sum strategy as against investing 240 times under an SIP strategy. So from a numbers perspective, while on the face of it, it seems that the lump sum strategy would create some really good advantage for the investor, the numbers don't support that really, because if we had invested in those 27 occasions when the market had dipped by 5%, the CAGR comes to 13.9% per annum. Now, as against this, if we had done the simple monthly SIP over those 20 years, then the annual returns would be 14.9%, which is 1% higher than the lump sum strategy. So one has a lot more to gain by not trying to time the market, but by rather being within the market for a longer period of time. If I'm not wrong, I think we also have a video around this on the ET Money YouTube channel. So if you haven't watched it, then I would definitely recommend that you kind of watch that video.
That'll help, Shankar. Thanks for sharing the video specifics. And for everyone who's watching this video in Hindi, we have recently started our YouTube channel in Hindi. और अगर आपने अभी तक उसको सब्सक्राइब नहीं किया है तो प्लीज़ जाके हमारा हिंदी चैनल सब्सक्राइब कर लीजिए. All right, and this next question, Shankar, is it risky to invest in mutual funds at the present moment when the markets are at high valuation?
All right, I think this question is a bit related to the one that you just asked me. I think the only difference is that we were talking about investing during market dips in the previous question, and this question is more on investing during market highs. Again, if we refer to the numbers, there have been 61 months in the last 20 years when the markets have reached an all-time high. And I'm sure in each of these 61 months, there would have been many investors asking the same question, that should I be investing with the markets being so high? Now, if we again look at the numbers, if we had invested in those 61 all-time high occasions, which by the way is the worst time to invest, even then the annual returns would have been a respectable 11.7%. So what really helped here was the long runway of 20 years and the fact that there has been a corresponding growth in corporate earnings, which will continue to fuel the share prices over the next 1, 5, 10, 50 and even hundreds of years. So if you have a long-term horizon, then the risk, or might I say the perception of risk, can be easily diluted. But if you have an investing cycle of just 2, 3 or 4 years, then things can go either ways. I also like that word that you used in the question, the word risk, because in many years of investing, my definition of what is high risk and what is low risk has become a lot more crystallized. For instance, and this is totally my belief, that if you are investing in equities for the short term, then you're taking more risk. If you are investing in sectoral or theme-based funds, then I think you're taking more risk. If you are not investing in a combination of funds like we had discussed earlier, then that's high risk. If you're not rebalancing your portfolio, then you're not managing your risk. Similarly, if you're investing in assets and instruments that you don't understand, then in my opinion, you're taking a lot more risk. So net risk, while it will be always there, it is also my belief that what you do around your portfolio is going to be more important than taking tactical calls on when is the right time to invest. And the more you can understand that, I think there is a higher sense and a higher case for you to actually reducing your risk and actually improving your returns.
But Shankar, you say long term, the AMCs say long term, and while I clearly understand where you're coming from, there is always the fear of the share market crashing just before I'm reaching my retirement age of 60. In that case, if the crash does happen, what will happen to my returns?
Okay, so the best way of understanding this is to convert it into a mathematical problem. So we need to define what a crash is. And nowadays, even a 10-15% dip is being labeled as a crash, which is really not the case. So let's take three numbers. Let's take a 75% crash, which means that you lose 3/4 of your portfolio. We can take 50%, which means that your portfolio has halved. And let's also take 33.3%, which means that your portfolio loses 1/3 of its value. Now, we need to make two assumptions. One is on the annualized returns that we're going to make over the time period, and let's take this at a standard 12%. And the second assumption that we need to make is the time duration, and I'll take a decent runway here, so I'll settle for 30 years. Now, when we plug this in a simple lump sum investment model, which means say I invest 1 lakh rupees in year 1, and for 29 years in a row I receive an annual return of 12%. But let's say in the final year, that is the 30th year, the market crashed by 75%. In this scenario, the overall CAGR that I would have made over this 30-year period would be 6.5%. If the crash in the 30th year was not as severe, so let's say it was a 50% crash, then the CAGR would be 9%. And if that fall was 33%, then the CAGR would be a little over 10%. So it's not as bad as what some people perceive. People think that the crash will come and all their money will be wiped off. Actually, that's not happening here. In fact, as a bonus, let's now assume that this 33% crash doesn't happen once, but happens twice in these 30 years. So the first one happens in year 15, and let's say another crash of 33% happens in year 30. In that case too, the CAGR would come to a decent 8.2%. And if you were to assume 3 crashes, let's say one 33% crash in the 10th year, the another one happens in the 20th year, and let's say the third one happens in the 3rd year, then in spite of all these 3 crashes, your CAGR will still come to 6.3%. So it's not as bad as what one might have initially thought, and a simple Exceling can give investors a better assurance across different scenarios.
Perfect. This was a good example, Shankar, really a good example. Now here's a question which is on a different type of risk. One of our investors is asking, what happens if the AMCs goes bust or it runs away with investors' money?
All right, so for the record, there has been no instances of this happening in the past, but as we are used to hearing, anything is possible. So let's understand why fund houses shut down. So some AMCs shut down because the business is unviable. That is, they can't turn it into a profitable business. That's understandable. Some AMCs also face a very unfriendly situation, like there can be a conflict of interest if, let's say, one organization or the mother organization is getting acquired or merged with some other company, and therefore they might choose to close down the unit. Also, what happens, and especially in case of foreign asset management companies, is that the foreign parent ends up taking some extensive business calls and sells their business in some countries and even worldwide. So in that case too, the AMC either shuts down or kind of sells its assets to some other AMC, normally a domestic AMC. However, as an investor, you need to have that confidence that your money is not going anywhere, and as a part of the closing down process, the money will either be returned to you or it will be moved to a new fund house according to what you decide. Of course, during the process of closing or selling, the SEBI would be a prime stakeholder and will be involved in many aspects of this particular transaction. With regards to the part where the AMC runs away with the money, what one needs to understand here is how a mutual fund is actually structured. You see, the AMC actually operates as a paid professional entity with fund managers, research analysts, etc. that are appointed to manage the scheme's investments, against which they get a management fee as compensation. It is actually the custodian that keeps the custody of the securities which are purchased by the AMC on behalf of the investors. And then there are also the trustees who keep a check on the AMC and the custodian to ensure that these guys are doing a proper job. So in effect, a mutual fund is actually a trust, and the investors who have really pooled in their money are the actual owners of that trust. So that's a bird's eye view of how a mutual fund is set up. And if anyone wants to know more about how these funds are kind of structured and what the roles and responsibility of each party is, then you can go to any website. I'm sure they have tons of information there. The point here is there are many checks and balances in the structure, and with SEBI overseeing the entire framework, it is a bit exaggerated to think that someone will kind of run away with your money. Of course, that doesn't mean that investment losses cannot happen, but those would be because of some other reasons, like mistakes made in analyzing a company or taking a very risky investment, etc. But probably not because someone has kind of siphoned your money and run away with it. That's like very unlikely.
Thank you, Shankar. It was a real pleasure having you here. And thank you everyone for tuning in today. We look forward to bringing you the next episode of ET Money Answers. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.